Good morning. It's another week of Business Morning. Thank you for joining us. I'm Ladi Williams.
And I'm Chimize Obi Iwagu. Good morning. Well, the 2021 first quarter real GDP came out stronger than the fourth quarter 2020 figures at 0.51% year-on-year, and indicative of a slow but continuous recovery. This marks the 2 consecutive quarters of growth following the negative growth rates recorded in the second and third quarters of 2020. The first quarter 2021 growth rate was, however, slower than the 1.87% growth rate recorded in first quarter 2020. Nevertheless, quarter on quarter, real GDP grew at minus 13.93% in the first quarter of 2021 compared to fourth quarter of 2020, reflecting a generally slower pace of economic activities at the start of the year.
And the oil sector recorded real GDP growth rate of negative 2.21% in the first quarter of 2021, indicating a decrease of negative 7.27 points relative to the growth rate recorded in the corresponding quarter of 2020. Compared to the fourth quarter 2020, which recorded a negative 19.76% growth rate, growth in the first quarter of 2021 was higher by 17.55%. Quarter on quarter, the oil sector recorded a growth rate of 35.65% in the first quarter of 2021. In terms of contribution to aggregate GDP, the oil sector accounted for 9.25% of aggregate real GDP in the first quarter of 2021. Slightly lower than 9.5% recorded in the corresponding period of 2020, but higher than in the preceding quarter, where it contributed 5.87%.
The non-oil sector grew by 0.79% in real terms in the first quarter of 2021, which was minus 0.75% points lower compared to the rate recorded in the same quarter of 2020 and minus 0.89% points lower than rates recorded in the fourth quarter of 2020. Our growth in the non-oil sector was driven mainly by the information and communication sector, while other drivers include agriculture, particularly crop production, manufacturing, we're talking about food, beverage, and tobacco, real estate, construction and human health, and social services. In real terms, the non-oil sector accounted for 90.95% of aggregate GDP in the first quarter of 2021, higher than its share in the first quarter of 2020, which was 90.50%, but lower than 94.13% recorded in the third quarter of 2020. Well, we'll discuss this further on the show.
Well, in the meantime, the Monetary Policy Committee is starting its policy setting meeting today. The meeting, which will be the third one this year, is coming at a time of fascinating developments in the domestic and external economy. In the domestic economy, inflationary pressures cooled down in April despite lingering supply-side challenges. On the external front, risks to global economic growth remain roughly balanced despite emerging bumps that could undermine our reflation trade and the commodity supercycle. At the last MPC meeting in March, members voted to retain all monetary policy parameters within the MPR at 11.5%. While some analysts see a little hike in rates this time, others believe that the slow pickup in growth could reinforce the central bank governor, Godwin Emefiele's view that it's still too early to increase the key interest rate from 11.5%.
And global oil market prices rose this morning during Asian trading hours. U.S. crude was up 0.83% at $64.11 a barrel, while global benchmark Brent was up 0.83% at $66.99. Last week, both contracts registered weekly losses amid concerns of more Iranian oil hitting the market. Iran's president reportedly said the U.S. was ready to lift sanctions on his country's oil, banking, and shipping sectors. Still, investors appear to be upbeat about fuel demand recovery in the U.S. and Europe as countries emerge from lockdowns and more vaccinated individuals plan their travels over the summer.
And back to the first quarter 2021 GDP numbers, which came in yesterday evening at a slow but continuous recovery. Paul Alaje, lead economist at SPM Professional, joins us in a moment. This is Business Morning. Stay with us.
All right, Paul Alaje, lead economist at SPM Professionals, joins us now to give us his first words on the GDP numbers. Thank you very much, Paul, for joining us on the show. Good morning.
Thank you for having me, and good morning.
So 0.51% as against 0.11% in the fourth quarter 2020. That can be termed anemic. And 0.51% as against 1.87% in the first quarter of 2020. That's a contraction. And when you compare this growth rate relative to population growth of about 3.2%, according to National Population Commission, that is poverty for many Nigerians. So, should we be cheering about these growth numbers?
Well, the growth number comes with mixed feelings. 0.51%. It's good news compared to where we were this time a quarter ago, which we had a year-on-year report to be 0.11%. So we are still moving in upward direction. But this growth is very slow. This growth is not fast enough. This growth is still crawling. But we should first be happy that we are not going down. We are not going to the negative territory. But what should be of concern should be the subsector division. What are the sectors that are growing? What are the sectors that have continued to remain low and backward? And which sector have started picking up? If you look at telecom sector, which was among the champions we had in the first quarter report, is still positive, but the positive rate is now almost 50% of the rate of growth. What does that mean? So we should also look at agri sector that's also returned positive. But when you compare that with what we had in last quarter report, talking about Q4 2020 year-on-year report, why did we have a difference, some growth, but when you compare it to what we did this time last year, it's also not good enough. So when you look at it, it's as if there's efforts to move, but the key fundamental of growth has not been adjusted. That is why we keep saying positive growth that is not sufficient enough. But when you look at where we are coming from Q2 2020, where we had minus 6.4, and Q3 where we have negative more than 3%, you would agree with me that yes, we're in positive territory, we have recovered, but this recovery is not sufficient enough.
All right, when we look at the sector growth, as you mentioned earlier, the growth rate of the agriculture sector, which is job elastic, slowed in the first quarter to about 2.28% from 3.42% in the fourth quarter of 2020. We can't attribute this to the insecurity situation, but what do you make of the policies towards boosting agriculture?
Well, policy toward boosting agriculture, some of them are commendable. You recall that Central Bank has taken the lead through Anchor Borrowers program for selected produce, which include rice, in some areas cocoa, and some other farm output. Those are commendable things. But what seems to be missing is connection between the farms and the market, our research institutions, and our farms. So, and there is no way you can excuse security and provision of power on our farms and beyond our farms, our livelihood, because eventually production is not completed until it is consumed. So farmers find it very challenging when you know that in suburban Kaduna State you could be kidnapped and you have to pay ransom, and the cost of what you sell your output, I mean the revenue we generate from output of farm is not commensurate with the ransom we hear on television. So it really does not make sense for farmers to go to farm when they know that what seems to be ubiquitous now is banditry and kidnapping, particularly around the food zones that we have. I know we can produce food in every part of Nigeria, but when you need to pay critical attention to North Central region and Northwest. They seem to do better than all other regions in some output of food. You can look at rice, for instance. You give it to Kebbi State. You come to North Central, you give it to Nasarawa State. Apart from that, you have Niger State. And when you look at these regions, apart from Kebbi, Nasarawa State Governor has mentioned the presence of Boko Haram training. Niger State Governor in recent time has also mentioned. And what are the areas that are affected? Areas with high level of insecurity. Leave GDP, let's look at the implication on the cost of food. According to National Bureau of Statistics, for the first time in a long time, we have seen a reduction in inflation on just 5 basis points, from 18.17% now to 18.12%, even though many people in the market are wondering how true that figure is. And I've said, well, you need to trust it, because when the figures were not so good, some people accepted it, some people did not. So you may not totally agree with what authority has published, but that is the only authority we follow for now, so we have to agree with them. But 18.12% is worrisome, is disturbing. And so when we talk about the insecurity and power supply, and more importantly now, logistics, moving from one point to the other. And when you look at the avenue kidnappers have used, people have been stopping their vehicle, march to our forests, to our bushes, and they've sent videos or call their relatives for ransom to be paid. So this is a big issue we need to be concerned about. We are seeing GDP figure saying there are concerns we need to do about food. We're also seeing inflation figures that are saying we need to do a lot about insecurity. And the numbers don't lie.
So now, two disturbing trends, not only from this data, but has been historically consistent, is that real GDP growth is much slower than potential GDP growth. For example, in 2021, potential GDP growth, according to the EIU, is 8%, which is approximately 7.5% above real GDP growth. Now, this means that Nigeria is in a recessionary gap. Can you explain to us the implications of an economy that is stuck in a recessionary gap, and how do we get out of this conundrum?
Okay, so when you look at our production possibility frontier or production possibility curve as a country, you see a lot of young Nigerians with huge capacity which can be used at the manufacturing sector. We have enough sunlight that can support solar system, talking about power supply. We also have enough irrigation system which government can look into. But you see, ability to combine factors of production is what makes production happen. And who is the person to combine factor of production? For business, private sector is entrepreneur. For public sector, is the person, the chief executive, either in state or local government or at the federal government. But when those who are supposed to take responsibility don't know what to do or don't know enough what to do, I am sorry, you will keep seeing the gap. And the gap will come in evidence. The first evidence is unemployment figures. According to National Bureau of Statistics, 33.3% is unemployment figures. Unemployment is 22.8%. These are not my figures. National Bureau of Statistics Q4 report that the agency shared. When you put those together with inflation figure of 18.12%, you can measure what misery index is saying. And when I say unemployment figure, unemployment is not on the entire population of Nigeria. No, population is approximately 208 million people. Labor force, which affects unemployment, is a bit less than 90 million people. But if we are charitable and we say it's 90 million, you have 18 million people that are not qualified to work, that are not able to work, that cannot work for one reason or the other, that have to depend on 90 million people. Unfortunately, of these 90 million people, another 30 million cannot get decent job to do, according to National Bureau of Statistics. Add those to 180 million people, then you have 148 million people that are jobless, that cannot add effectively to the economy. You need to depend on 60 million people. Of the 60 million people, you have approximately 20 million people that are underemployed. So we should not be surprised that you are seeing banditry. You should not be surprised that you're seeing kidnapping. You are seeing people attacking police station. New trend in Southeast. You should not be surprised because the economy that will keep people at job is lean, even though I strongly believe it can do more. And one of the things that some persons have said in authority, both state and federal and even local government, is that there are no monies anywhere. And I doubt that statement. I doubt those statements saying we don't have enough, there are no monies anywhere. If you look at 2021 budget, government is projecting approximately 8 trillion naira revenue. This economy, particularly the federal government, should not do less than 40 million revenue. If you keep doing less than your potential, you will keep borrowing money. You've seen the new borrowing plan by Mr. President sent to National Assembly, 2.3 trillion naira. That money can be generated alone in telecom within 6 months if government know how to. I strongly believe that federal government of Nigeria is doing less in terms of revenue generation. And by this, I'm not saying you should task cyclists, locally called Okada riders. That's not the solution we are saying government should adopt. We're saying there are sectors, even from the report we are looking at today, if you look at sectors that grew the most, you would agree with me that telecom seems to have done well. When I say telecom, I'm not talking about the big names. There are organizations that are returning trillions of naira that government may not know about. I doubt if government know about this information. And these are people that are paying less in terms of revenue to the covers of federal and state government that I strongly believe if the right thing is done, government at federal level can do 40 trillion naira and state level can do cumulatively approximately 50 to 55 trillion naira. And you will not need to borrow. Such money will remain within our economy. Owners of those companies will not repatriate those funds back to their economy, giving our foreign reserve pressure, making exchange rates to be devalued, etc., etc.
All right, Mr. Elijah, but before I let you go, what do you think needs to change in terms of policy to ensure that the economy, returns to a more positive growth trajectory in the shortest possible time? And, considering GDP data and inflation data, coupled with vaccination rollout, how do you see this affecting the MPC decision?
Well, I think MPC, to start with that, will retain rates because when you look at inflation, you only have about approximately 5 basis points. When you look at growth rate is about 40 basis points. Those are just too slow. They are too slow. They are too minute for you to base your decision on. When you look at poverty, hunger, you look at inflation figures, they are still very, very high. So I don't think Monetary Policy Committee will decide because those are very fragile growth or things you can measure. But when you talk about what policy government should do, I think government needs to move from handout economic policy to economic policy that is geared towards development. Economics, you either focus on development, which will sandwich growth. So the day you start, the time we start seeing our GDP growth rate, we have seen it before. It's just that government at that time, they were focusing on growth. But if you focus on development will sandwich growth. There is no way you will develop without growing. But over the years, in the last 3-4 administrations, what I've seen is that Nigerian authorities have always wanted to grow without having conversation around development. Because of limited time, there is no sufficient time to look at what are the critical areas government should pay attention to and take decision on. It might not directly be government effort. It could be privately sponsored. It could be government idea, government initiative, or privately sponsored, privately executed. Then you can see significant development. If we don't do this, I'm afraid we will continue to have growth 1%, 2%, 0 point something percent, and call that from 2015, we've not grown up to 3%. Not one time have we been able to meet the population growth of the population commission, which is about 3%. And so we continue to grow in terms of numbers, but economy that sustains us, I'm afraid, is just too low for us to depend on.
All right, thank you very much, Mr. Paul Alaje. You just said it, critical areas that government should focus on. I think that's a separate conversation, and I guess we have to keep a date on that particular issue on this show. Thank you very much for your time.
Thank you so much for having me.
After the break, we'll get market perspective on the GDP numbers. Tajuddin Ibrahim, Head of Research at Chapel Hill Durham, joins us next. Still on the GDP numbers, let's hear from the Head of Research at Chapel Hill Durham, Mr. Tajuddin Ibrahim. Thank you very much, Mr. Ibrahim, for joining us on the program. Good morning.
Good morning, and thank you for having me.
So 0.51%, was that in line with analyst expectations? In any case, the debate in financial markets is now not so much about how quickly GDP can recover, but rather the shape of recoveries. Am I right?
Yes, you are very correct. And I think the first thing to start with is the 0.5% number that was reported by the MBS is in line with our expectation of 0.5%. And if I may talk or speak further on the numbers, what really was a major number to discuss or to talk about is the telecom sector. That number for the entire GDP will have been a lot more robust if we have had stronger numbers in terms of growth in the telecommunications sector. Nevertheless, the 0.5% is consistent with market expectations, and it speaks to further recovery of the economy post the pandemic and also post the lifting of lockdowns across the country. So it is in line with what the market was expecting.
All right, Mr. Ibrahim, interesting. But the GDP numbers show the relative flatlining of growth. Some market participants are of the view that the relative slow growth and the marginal dip in inflation means that the MPC is likely to maintain status quo at its meeting tomorrow. Is that also the position of your analysts at Chapel Hill?
Well, at Chapel Hill, Denham, what we believe is there will likely be a change in the monetary policy rate. We expect between 50 basis points to 100 basis point increase in the MPR, based on the current ongoing meeting of the MPC. And the reason is we have inflation still at over 18%. We agree that it subsided a bit in the month of April, but the reality is that it is still on the high side at above 18%, where the monetary policy rate is as low as 11.5%. So that is number one. Number two to bear in mind is that currently, as we speak, the financial market has moved ahead of monetary policy in terms of interest rate movement. Yields on the 10-year bond, for instance, are around 14%. And if you go further down the yield curve, the much longer end of the yield curve, what you find are yields that are well over 14%. So what that means is that the monetary policy rate has now become a lagging indicator in order for you to gauge the direction of interest rates. Even if you take a look at the short end of the curve, what you find is that treasury bills also have gone up in terms of the discount rates at the primary market auction. So that speaks to interest rate movement in the financial market without a necessary movement in the interest rate, based on the Monetary Policy Committee decision. So what we believe is that 50 to 100 basis point increase is possible in the current, for announcement, after the current meeting. Bear in mind that the decision to hold rates at the last meeting was not unanimous. We had some members of the committee that were asking for a rate hike. So these are our views at Chapel Hill Denham. We believe if they do not implement a rate increase tomorrow, most likely the meeting that is coming next in July, there will be a rate hike. So by about 50 basis points to 100 basis points, particularly bearing in mind the weaknesses that we are seeing in the foreign exchange market.
Now, the Nigerian stock market has already been trading negatively all of last week. How do you see investors at both the equities and fixed income markets now reading these numbers?
Okay, so equities in the first case, as you said, has been in the negative terrain, and that is largely speaking due to the repricing that we are seeing in the fixed income market where yields are going higher. So investors really wants to tap into the higher yields in the market. So leaving equities on the back burner in that case. And what we believe, nevertheless, is that we still have valuation being cheap in the equity space. And on the back of the current GDP numbers that were published, what we believe investors should be doing in the equity space is to take a look at sectors that have demonstrated resilience, sector where we are seeing stronger growth relative to the last quarter. And I believe very strongly that investors should be taking a look at the telecom sector, the agri sector, and also, most importantly, the cement sector, where we saw a very strong double-digit growth in GDP in the first quarter of this year. So that is on equities. If we speak to fixed income, I think investors in the market are still waiting for the decision of the MPC to be announced tomorrow. Before that decision is announced, it is unlikely that the market will be aggressive in terms of how they play in the fixed income or money market. Nevertheless, the trend is more to the upwards. It is more to the upwards in terms of yields in the market, and we expect yields to go higher substantially if there's a rate hike tomorrow. But if there's no rate hike announcement, what we'll probably see is a gradual upward movement of rates, considering the low liquidity in the financial system as a whole.
All right, so the saying goes, sell in May and go away, but some pessimists are even saying now that you sell in May and stay away. We saw the highest level of volatility in the crypto market last week. Many investors were burnt and are licking their wounds right now. Do you think that the Nigerian investors will have the enthusiasm to overcome the current fatigue in the market, particularly with the slow, growth as we're seeing right now?
Well, I think what really matters is, the saying that goes like sell in May and go away. That saying made a lot of sense when foreign investors were still in this market, and when they were sort of controlling the market in terms of participation. But these days we have, largely speaking, local investors, the PFAs in this case, the insurance companies, the local investors are the ones sort of driving the market as we speak. So even if you sell in May, you are going nowhere. As a local investor, you are in this country. So what really matters to me is cherry picking, a case where investors take a very careful look at sectors that present compelling growth opportunities. Equities will be on the back burner just for a while, and because there will be a peak, there will be a time that interest rates will peak, and at the moment that materializes, we will begin to see more interest in the equities market. And if we take a look at earnings announcements, the earnings that were announced in the first quarter were good. If we see such momentum in the second quarter, chances are that before the end of June, investors' interest in equities will pick up again. Don't forget that all stocks in the market are not performing at the same rate. The performance, across the sectors is different, and that suggests to you that you will continue to see the blue chips, such as the MTN of this world, such as Dangote Cement, such as Lafarge Africa, Seplat, and like a Nestle, for instance. You will still find those as compelling investment cases. If you also take a look at the banking sector, we believe investors should consider the likes of GT Bank, consider the likes of Zenith. You are not considering them just for cheap valuation alone. You are also considering them because of the free float, that is substantial for them, that allows you to go into those sectors and, buy stocks, that are liquid, and it also allows you, when you want to exit for whatever reason, allows you to also exit. So those are, what we have been discussing with our clients and the direction we believe they should be going in terms of equities investment for the second quarter of this year.
Yeah. Now, looking at these GDP numbers, the manufacturing sector impressively grew by 3.40% in the quarter on the review from a negative 1.51% in the fourth quarter of 2020 and, of course, 0.43% in the first quarter of 2020. What impact is this likely going to have on manufacturing stocks or stocks, manufacturing-related stocks listed in the exchange?
So the impact is positive, and what we expect is that the sector's performance, in the first quarter is an indication of a recovery from the weaknesses that we experienced in the past 2 to 3 quarters. And bear in mind that the cement sector had a very strong growth number of 11.2% in the first quarter, and that speaks to increase in the volumes of cement bags that were sold by cement manufacturers in the country, led by Dangote Cement, followed by BUA Cement, and the third being Lafarge Africa Cement. So when you find private sector investment rising, demanding more for cement, you will find a better real estate sector. You will find a stronger cement sector, and as a whole, you will find a stronger manufacturing sector. When you also find cement distribution going higher from one city to the other, what you should expect is robust earnings by the cement manufacturers. And what we believe in is that investors, if you take a look at the GDP and you want to play the market, you should play in the manufacturing space. And we strongly recommend the cement sectors, the cement stocks. In this case, the number one of them being Dangote Cement, number two being Lafarge Africa. From a valuation standpoint, we believe BUA is expensive as we speak. Nevertheless, investors that want to take a very long view at the company may consider buying into the stocks, because the Q1 GDP numbers is an indication of the earnings that will be reported in the second quarter of this year. And those earnings, to my mind, will be a lot more robust. And chances are that, some of them will consider interim dividends. It is not impossible.
All right, Mr. Tajuddin Ibrahim, thank you so much for your time on the program. Mr. Tajuddin Ibrahim is the head researcher at Chapel Hill Denham. Thank you so much.
Thank you for having me.
All right, let's look at what the market numbers are saying with Aniete. Aniete, last week was brutal for equity investors. Perhaps this latest, GDP might offer some hope, to push the numbers higher this week.
Well, good morning, Ladi. I hope to share your optimism, but the market is still reeling from that massive and brutal week. We lost about 620 billion naira last week. And of course, when you take a look at, let's pick up from where we stopped on Friday. The markets, over the weekend, we lost nearly 3%. And that's because of the massive sell-off that's affected large and mid-cap companies across board. The Airtels of this world, the Dangotes of this world. So take a look at the impact. Although it didn't have much impact for the volume of transactions, or we had about 1.4 billion, 1.4 billion in volume, and then more than 11 billion naira in value. But then when you take a look at the sectors, banking all across board, it was in the red. But only the oil and gas sector was up because of Seplat's gain. So now to give us more details about the market, especially as we start Monday, let's join David Adorin, as a stockbroker at High Cap Securities. Thank you for joining us, Mr. David.
Yeah, thank you. Good morning. Nice being with you.
Okay. So now we are starting a new week, the fourth week of May. And for the better part of the month, We've had a lot of bloodletting, more than, just last week, more than 600 billion naira lost. What was the main driver for that loss? And, which is that with the MPC's meeting, what are we to expect from the market?
Okay, thank you very much. The market is feverishly awaiting the decisions of the MPC, hopefully this week. And that may chart a course for the capital market. But let me briefly touch on the comments you made regarding the decline we have witnessed in the equities market in the past few days or even weeks. That is correct. The market has actually declined. And just last week, we saw an uptick in the demand for bonds. So what happened was that there was a migration of financial assets from equities to bonds. For instance, the price of bonds appreciated last week, while that of the equities declined, indicating that investors' confidence had been on decline since the first quarter results hit the market. So apparently there has been nothing dramatic or what we call price-sensitive development capable of attracting funds into the equities segment of the market. And so we find the bond segment now firming up both at the primary and secondary market. So there is migration of financial assets, therefore, from equities to bonds. But what are the upside factors that are capable of reversing this trend? First and foremost, the crude oil price is stable. Then secondly, we also have declining inflation rates. I'm sure we're all aware of the recent figures released by Bureau of Statistics. And then thirdly, we're having a situation where COVID-19 pandemic appears to be fading away in Nigeria. So those are upside factors that can reverse the trend we are seeing. But what are the downside factors that can exacerbate the decline in the market? Number one, insecurity continues to deteriorate with undiminished intensity. Secondly, there are uncertainties anyway, just like we mentioned at the beginning, concerning the monetary policy meeting that will come up with decisions, I think tomorrow or so. That will give us an inclination as to how the market will proceed into the immediate future. Thirdly, we're also aware of the rise of interest rates in the U.S. So this has a way of migrating assets away to the advanced economies.
Okay, David.
So if we are therefore looking, are you still with me?
Yes. So, I may have to cut you there so that we can get back to the studio. So thank you for bringing us up to speed at the market.
Okay, it's a pleasure.
Okay. So that was David Adorin, a stockbroker at Highcap Securities Limited. So, Chimi.
Well,
okay.
I guess we'll keep our fingers crossed this time. You know, Mr. Ibrahim said the sector to watch is actually the manufacturing sector. So we'll keep watching that. Thank you for the update. We'll take another quick break now. When we come back, we'll do an opening call to London. Do stay with us.
Okay, before we cross over to London, let's quickly take a peep into the crypto market with Laddie Williams. Laddie, it was a stormy weekend for the crypto market, particularly Bitcoin. How is that market holding up today?
Well, let's look at the mood, first of all. Fear Greed Index, 10, extreme fear. Well, for this one, it will be sell in extreme greed and go away. That would have helped you a lot in this market. Market cap $1.49 trillion traded, down about 1.11%. 24-hour volume is up about 70.18% this morning. Bitcoin dominance still inching up there at 45.68%. We've broken the 30 region for now. Price of Bitcoin this morning, $36,707, down about 0.28%. We still have that test of 31,150 area. Bitcoin is still struggling below that 38,040K region at this point. Ethereum trading at 2,254, about 2.16% this morning. 24-hour volume not looking bad. About $59 billion traded this morning. Top alts by market cap. BNB, $288 from a high of $600 and something. That is how volatile this market can be. But it's up 0.33% this morning. Cardano is up 1.36%, but Doge and XRP are still struggling. XRP especially there, going below the $1 mark, down 6.29% this morning. You know, some traders are afraid that this might be the beginning of a bear market, but who knows? Who knows? MDX is up 31% this morning. You know, some alts are doing well, even though, you know, they've been brutally, you know, destroyed over the weekend. Matic, $1.40, up about 30%. Maker, it's $3,293, up about 27.54%. HNT there, $14, up 26.23%. And Harmony also joining one of the Binance IEOs. You know, Matic is an IEO too from Binance and Harmony there. So you might want to look at other IEOs at this point. Let's look at the top 5 losers. RVN, down 15%. SNX there, down about 14%. Nexo, $1.47, down 13.70%. So you see, we have double digits downs this morning. You know, one Bitcoin, the thing about this market is the market alts follow Bitcoin. Once Bitcoin is highly volatile, you can expect the altcoins to, you know, drop in massive points here, as we see with double digits there. So this market, you need to learn you need to trade this market with good risk management, because if you can, you know, find out when Bitcoin is going to actually be highly volatile, you know, you need to leave the market at that point and go into one of the stable coins. Well, let's talk to Olumide Addition, our financial market analyst. Hello, Olumide.
Yeah, hello, Laddie. Happy Monday. Good morning to you.
Happy Monday. You know, the bloodbath has, you know, kept on. I see Bitcoin and Ethereum recorded, you know, some losses this morning, but actually bounced, you know, surprisingly. But I don't see much upside. What do you think?
I think it's too early to call that, too early to discount the upside prevailing right now. I'm sure the past couple of days, I'm sure a lot of investors are already having weakened sentiment, because at one point, Bitcoin lost $10,000 within the span of 4 hours. But we saw that it bounced up after touching the support level, that's the $30,000 mark. And although that reiterated on Sunday, we saw that early hours of Monday, the coin has bounced up. And what listeners need to understand is that the crypto market is going under a lot of negative sentiments that include the crackdown on miners by the Chinese government, Powell's recent statement about digital dollar, and the fact that Elon Musk issued an environmental concern about the flagship asset, weakening institutional investment. And that's why we could see that from March, the late March to the point we are in, we saw that institutional inflows got weakened, and that really affected the price swings triggered by a lot of retail investors. So for now, Bitcoin is trading above a key support level of $35,000. It remains to be seen if it can break 40, but I think it's too early to discount that we are already in a bearish pattern.
Okay. All right, Olumide. We'll see how the market goes this week. Let's hope for a recovery. Thank you so much.
Yeah, thank you so much, Daddy.
All right, Chimi, that's
yes,
it.
Ladi, perhaps we need an Elon Musk to say something.
Well, some traders are actually angry with Elon Musk right now, so I don't know if this is the time.
Well, we will see how that goes.
Yeah.
Thank you, Ladi. All right, let's do our morning call to London with Juliana. Good morning, Juliana. Commodity prices are on the slide today, not just Bitcoin or the cryptocurrency. And this is after China announced a new crackdown on speculators and hoarders to deflate the boom in raw materials. How is that playing out in London this Monday morning?
Yeah, good morning, Chimisi. Well, red-hot commodity prices have fallen in London. This is after, as you were saying, China complained about the speculative excesses driving them higher. China's National Development and Reform Commission, they did show a stern warning, and they said they are going to be showing zero tolerance for monopolies in the market. Of course, as well, there's still lots of inflation anxiety, but stocks in London opened up 0.2%, and there were similar positive openings across Europe.
And Liberty Steel is set to be an £18 million loan breach with Metro Bank. Reports say Metro Bank had asked for early repayment of the loan from the troubled steel group Liberty more than 2 years ago. What's up with Liberty Steel?
Well, yeah, this is just the latest sign of trouble for Liberty's owner, GFG Alliance. I spoke about this last week. They're currently being investigated by the UK Serious Fraud Office for alleged money laundering and fraudulent trading. Now, Metro Bank, pretty small bank here in the UK, but they're reporting that they've been waiting for a repayment of £18 million for the past 2 years. Now, a spokesman for GFG Alliance has said that no loan terms have been breached due to non-payment, and discussions are ongoing. So we're waiting to see what happens there. Separately, over the weekend, there are suggestions that an Indian steel firm called JSQ is mulling over a bid of Liberty, although that is going to have a serious ramifications because Liberty Steel has become a political sensitive issue here, and any foreign takeover is going to be monitored very closely by the British government.
And of course, it's a new trading week. What's on the radar for the week?
A busy week this week. Tomorrow, pretty important day. We've got public sector net borrowing for the month of April. I believe the figure in March was about £28 billion. I think economists have got the figure to be probably in the range of about £34 billion. This is, of course, all down to the coronavirus job support schemes. And then on Thursday, we're going to be having a look at car purchases. I believe in March, we had an 18-month high of upwards of 46%. And according to economists, we could actually be getting a record high of 125%. But who knows? We have to wait for the data, and lots of corporate updates in between.
And we'll continue to keep a track on those. Quite a busy week, particularly on the data front, Juliana. And we do expect to get more updates from you later today. All right, that's it on the program for today. Thank you for watching. I'm Chimezi Obi Iwagu.
And I'm Ladi Williams. Thank you for watching.